Well, are rates up? Are rates down? Or are they confused? Today we're going to take a look. Stay tuned for Prudent Money. Good afternoon and welcome to the Prudent Money Radio Show. I'm your host, Bob Brooks. Thank you so much for joining me today. You know I do appreciate it. Well, if you got a question for me, I've got an answer for you. Just go to the website at www.prudentmoney.com and we'll get you taken care of, whatever that question might be. There's a link at the top of the front page that says Ask Prudent Money, and you do get your question answered. It doesn't go into some black hole somewhere. So we do get you taken care of. That's all at the website, www.prudentmoney.com. Well, today was one of those days. You get about, I think they skipped 2 months out of the year. But the Federal Reserve Board announces today what they're going to do, what their decision on interest rates should be. Now, I can't tell you how important these days are, because it's not only what the Fed says or what the Fed does, it's how the market reacts. And so far, since they've been increasing rates, decreasing rates, the interest rates in the market have not gone down. They've actually gone up. So that's something that we've got to keep a very, very close eye on. So what we're seeing is the Federal Reserve Board today comes out and says that they're going to lower interest rates by 1/4%. And that the Fed committee that looks over this and votes on what they're going to do with rates looks at it and says we're pretty divided on whether we should or not. And if you look at the end result, the interest rates in the bond markets, which is what's critically important, and let me explain a little bit about that, how that works, because you're looking at two different metrics. You're looking at in the one hand, you're looking at what the market is doing from the standpoint of, let's say, Treasury bonds, 10-year Treasury yield is going up or it's going down, versus what the Fed has set their benchmark, what's called the federal funds rate. And the Fed says this is what interest rates should be. And today they said should be lower. So if they're the authority and they're saying to everybody out that interest rates are affect, if they're saying that we're lowering our benchmark rate, then you should do the same, and they don't, they go up, there's a problem. And that's what we've been talking about on Prudent Money for a long time, is that the interest rates have just not gone down like they used to, and that is real problematic. What does that mean? Well, I said in the opening title, I said, are rates up, down, or confused? And I think that they're very confused, because on one hand, you've been to the grocery store, you've been out trying to buy a car, you've done these things, and what you're coming back to report, what I experienced as well, is higher prices. There is a level of inflation due to the tariffs. Give us a really good look at why we've got some inflation. But I mean, all you have to do is go to the grocery store, I think, to see the higher prices and that inflation is not going away. And the thing that's really concerning is that you've got inflation that could really take off. I don't think that's going to happen, but I think, though, that we're going to see interest rates get to a very uncomfortable level that is going to affect the one thing that we need to kind of unlock, which is the real estate markets, auto sales, everything that's influenced by interest rates, especially the mortgage markets. So why I say they're confused, because on one hand, you have this narrative that inflation's there. You're understating inflation. Indicators are not really being are not real accurate in describing exactly what's going on with inflation, down to what inflation? We fixed that problem. Yes, this came out of the White House. President Trump called it a hoax, that he's fixed inflation and it's not a big deal. So you've got inflation on one end, and that's what the indicators are suggesting and what real life is suggesting. Then you've got the White House that's no big deal. Which one is it? I don't know about you, but my pocketbook says it's a big deal. So the bond markets and the stock markets is confused because interest rates should be falling, and they just aren't falling like they should. And that's a really big red flag. So there's that. There is if you look at the unemployment numbers, which we don't have a good look at because they haven't published those in a while, very, very large lack of transparency from the standpoint of the White House. And once we get those numbers, we'll see what the deal is with employment. But there's kind of two conflicting arguments on employment as well. So who knows? It's no big surprise to me that there is a lot of confusion. I think we'll know a lot more tomorrow as the market follows through with the direction it's going, and will tell us one way or the other. But it's an interesting situation for sure, and I call it. I look at it like the economy and the markets are walking on a tightrope, and it wouldn't take much to kick them off that tightrope. So we'll see what happens. This is Bob Brooks, and you are listening to the Prudent Money Radio Show. Thank you so much for joining me today. You know I do appreciate it. If you got a question for me, wondering about inflation, wondering about the risk that you're taking with your investments, you can always go to prudentmoney.com, send me an email, and I'll get you taken care of. I love to get those emails and the information that you send in. That's all at the website, www.prudentmoney.com. Well, tomorrow and I talked about this the last couple of days actually, but I want to remind you, I am going to be interviewing Andrew Ross Sorkin. He's a co-host on CNBC every morning and a phenomenal writer. And he's written a book that I think that you definitely should check out, because it comes back to what I said yesterday. In the two verses of what I call risk and being a steward of what God has given you, being a manager of that risk. Proverbs 22:3, Proverbs 27:12, two verses, word for word, exact same verses, separated by 5 books in the Bible. In Proverbs, the book of wisdom. You think that God's trying to make a point. He says, a prudent person foresees danger and takes precautions. The simpleton goes blindly on and suffers the consequences. I don't know what's going to happen tomorrow, today, 2 weeks from now. As someone said the other day, I left my crystal ball at home to have no idea. But I do know that it warrants being on guard. It warrants making sure that you've got that you're invested appropriately for the risk that you're taking, that you're good with that. It makes sense to be dialed in, to be and stay informed on what's happening, because these phenomenons called stock market and investment bubbles, which I think we're in one right now, they all burst. And for those who are they represent the prudent person, they start to see this and they start to back off on risk. It's not about timing the market like Pop Culture Finance would tell you. It's about making sure you're at the appropriate risk level for the environment that we're heading into. I never want you to end up being the simpleton which goes blindly on and suffers the consequences. So this book is a phenomenal look at what happened in 1929 and he did just a great job on telling the stories. It's a collection of stories and takes us through the years of the main characters of not only what happened in prior to 1929, but the great crash of 29, which started in October and went down negative 86% down to the bottom in 1932. I believe it was June 1932, and then started a recovery that took a very long time. I'm not saying that's going to happen, and you might say, especially someone that is really believes pop culture finance, that there's no way that can happen again. It's different times, different places, different cultures, different technology. I agree with all that. But something could happen that looks a lot like that, but has maybe different results or results that feel the same. And I mean, there's a lot of things that could happen because it comes down to this. Emotion is changeless. What spells greed, what spells risk, what spells power, all is the same emotions that were represented back in biblical days. That's why I think that there was a study done by Crown and Crown Financial Ministries, and they were talking about, or their study revealed that the most talked about or referenced subject in the Bible is money. Think about that. I always get kind of get chills when I think about that, because it's one of those statements that says God knows you're going to have trouble with this, and you need to get up the curve and on the biblical biblical view of money, not the world's view. And there's in God's economy. I mean, it's two totally separate, different looks at it. And this book is just a great reminder of what risk really means. And he said, I love this, Andrew writes on the very last page of the book, the enduring lesson is not that booms can be prevented or that busts can be fully averted. It is that we need to remember how easily we forget. The antidote to irrational exuberance is not regulation by itself, nor skepticism, but humility. The humility to know that no system is foolproof, no markets are fully rational, and no generation is exempt. The greater the heights of our uncertainty, the longer and harder we fall. I think there's so much truth to that we get caught up in the notion that, markets can't falter, markets can't come down. When they can, they've proven to it. When we've just forgotten. We've become a society so caught up in Bitcoin and speculative investing, when what happened in 1929 could easily mirror or rhyme with what happens today. Whereas we've got debt at the centerpiece of the centerpiece of the problem, and we got a lot of it. But yet, nobody thinks it can happen. 2008 was, something that happened a long time ago. People have forgotten the pain of what happened, and that's the problem. The further that you get away from it, and then you just don't think about it. Now, that's what's interesting. If you ever talk to children of the Great Depression, they remember, and their life is reflected by that memory. And what I mean by that is, these are children of the Great Depression, probably the most conservative investors, and they've got some just some remarkable stories to talk about. But people have forgotten '08. And in fact, Andrew wrote a book on that as well, Too Big to Fail. You've probably heard of that. But we got to be careful about, once again, taking risk and making sure that we're taking prudent risk. There's a gentleman that I follow. His name is Greg Manarino, and he's been predicting some pretty heavy stuff that could happen. But he does have some, and so you gotta kind of factor some of the sensationalism in just a bit. He has great information though. And I wanted to read some of this to you. U.S. household debt is ballooning. Our country has never seen this much household debt, which is layered on top of the government debt that we have today. And this all has an effect on the income ladder. And what he means by that is the middle class. You know, one of the things he talks a lot about in his writings is that the middle class is being chipped away at. And at some point, it's going to get smaller and smaller and smaller. The U.S. household debt just hit $18.6 trillion. Now, remember what a trillion is. A trillion is a million 1 millions. Up nearly $200 billion in a single quarter. Add 4.5% of that mountain is now delinquent, and that delinquent rate is climbing. Credit card delinquents and the auto loans are very concerning. We're seeing 5% of auto loans 90 plus days late. With that, 2.2 million cars have already been repossessed this year and on pace for roughly 3 million, the worst since around 2010. And these are all numbers that have been documented. Households are not trying to get out of debt. Instead, they are borrowing into weakness, which is getting worse. What they mean by that is they're borrowing to pay the bills. They're borrowing for survival means more so than they are to buy consumer-based things. If the economy was strong and politicians are selling us with Trump saying we fixed everything and calling inflation a hoax, people would be paying debt down. But that is not happening. Delinquencies are the big concern. 4.5% of all household debt is now delinquent. That is a new record high, never before seen in the history of our country. A milestone you don't want to be hitting. So it's no wonder why things are so confusing. As to, are we in a recession? Are we heading towards a recession? Are we in a situation where we have inflation? It's a lot of, and it makes me wonder, is this what you see occur before stagflation sets in? Now you go, oh, Bob, not another word. Stagflation is very simple. It is the combination of inflation and a recession at the same time. You're in two different directions. And I'm wondering if what we're seeing, because it's only happened really one time in the 70s, and it makes me wonder if this is the way things look before they go into stagflation. In stagflation, you've got the Fed who really doesn't know what to do. So we'll see what happens in January. They're already talking about the next rate cut. And, keep in mind that, well, two things. Keep in mind that in May of next year, President Trump will replace Fed Chair Jay Powell because it's the end of his term, and he'll put one of his guys in there. And President Trump feels very strongly about being in the process of interest rates and what happens with the Fed when there has been for decades a great divide between keeping the importance of independence and the Fed independent of all political influence. Well, you can forget about that because that's going to go by the wayside. And I'm sure that what the the president wants to push for much lower rates, which makes absolutely no sense. At least this is my opinion on it. It will produce a boom. I have an analogy for this. It's not a great analogy, but you'll get the picture. Take a drug addict, and that's been doing drugs off and on all day, and he's getting a little bit at a time. And the drug addict all of a sudden has access to a lot that he can take immediately. First, it produces a great high, and he sees that and enjoys that high and everything that goes with that for the remainder of the day into the night. And then, unfortunately, he ODs because he took too much. The economy is just like that. You lower things like interest rates too low, and you're going to create a real problem. Now, we've got, 38 and a half and counting trillion dollars worth of debt that lower interest rates would be much better on, but it goes so much deeper than that. That's in addition to the inflation problems. And the risk is absolutely a long list of things that could happen. Markets will take off. And I know you're thinking, well, what's wrong with that? Think of the drug addict taking too much drugs. That's just like the economy taking too much stimulus with lower rates. And it doesn't end well. And history would show that. So once again, the name of that book is 1929. And it'll be interesting to get a good perspective from Andrew as he has researched this amazing book that he put together. And I mean, it's got a whole, something like 25% of its documentation that all the resources and references he's gone through to write this book. But there's two questions that need to be answered. The first one is, what do you feel like, or how does today look like 1929? Because it was amazing to read through this book. Actually, I listened to it on audio, and to find all the similarities between then and today. It's just concerning, is what it is. And then, what does this say about today, 1929, and everything that happened? Because that was a absolute mania on every level. And what he talks about is that it wasn't until the middle 20s that people were introduced to debt. And debt set all this on fire, and it's gotten worse ever since then. And debt's a tool, not a very good tool, but it is a tool that economies use. And we've got plenty of debt to last us. So I'll ask him those questions. It'll be great to talk to him. That's tomorrow on the program. And if you, by chance, missed the program, you can always go to wherever you like to listen to your podcasts, and you can listen to it there. Very easy. We do podcast every program and put it out there after the show at around 5. So that's all at the website at prudentmoney.com. And you also find a lot of other resources there at the website. Go check it out. It's let me know what you think. Make sure, though, that you do get on the email letter list, because that is how you stay informed with Prudent Money. So go sign up for it, and we'll protect that email. We won't give it out to anybody. And that way you can stay on top of what you need to know. This is Bob Brooks, and you are listening to the Prudent Money Radio Show. We are all out of time, but until we do meet again next time, keep the faith and have a great day.
That's all the time we have for today. Questions or comments for Bob, or to find out more great information like what you've just heard, visit www.prudentmoney.com. Be sure to join Bob Brooks again for the next edition of Prudent Money.